So let's get started and jump right into our topic today. So thank you everybody for taking some time out of your day today to join us here on our webinar. If you haven't joined us before, just introduce myself. My name is Jonathan Brandao. I am the Director of Learning and Development here at MLB. And today what we're doing is we're going through our Streamline Refinance Programs. Now, these are the types of the programs that a lot of people are talking about currently, these streamlined options for the borrowers that are eligible for it. So we thought it would be a great time to take the opportunity and jump on and get everybody kind of educated on what these programs are, what MLB is currently able to offer, and how you can confidently go out there into your market, talk to your borrowers, your realtors, and find those people who are eligible and help them out with these streamlined opportunities. Now, the great thing is that these programs are designed with that name Streamline. They're designed to make refinancing on a home faster, simpler, and much more accessible for borrowers who already have government-backed loans. Specifically, today we're talking about FHA and VA. In many cases, these types of programs have limited documentation, no appraisals, and significantly faster underwriting turnaround times because we're asking for such limited documentation compared to, let's say, a rate and term refinance or even a cash out refinance. These streamlines make it so much faster and easier to get through that process. And for you, as a loan officer, these programs create real opportunities to reconnect with clients of your past. You may have helped them purchase that home in the past, and now you can come to them again with another opportunity and open up another loan in your pipeline with that exact same client that you helped out with the original purchase, helping them reduce their payments and overall putting these families into a better financial situation. And overall, that perfectly aligns directly with the mission here at MLB, which, as always, is making lives better. So let's take a look at the FHA Streamline, the VA Earl, as they call it, as they are two streamline programs we're going to talk about today. So first off, let's talk about why streamlined programs matter. I touched on that a little bit already, but just to kind of go into the basics here. Traditional refinances, even though they have kind of your straightforward guidelines, sometimes they can feel much more complicated than somebody really wants to deal with at that time. They often require full income verification, appraisals, and extensive documentation. Whereas with a streamlined program, you're removing many of those different types of barriers. It allows a borrower to lower their monthly payments, lower their interest rate, refinance with minimum documentation, and close much, much faster than a traditional refinance. So those borrowers are getting delivered real savings much faster than they would on a traditional refinance transaction. So, from a business perspective, this means faster loan cycles, more satisfied borrowers and clients on your end, and more opportunities to build long-term relationships with the partners that you are building relationships on your end. Because it's not just about the families you're helping, it's also showing that you are a partner that people want to partner up with. And they can then provide you with more leads when it comes to these types of opportunities because they say, oh, wow, I love partnering with them on this particular project. So that's where those streamlined refinances come as a major part and a great item to have in your toolkit when it comes to that piece of it. Like I mentioned, the two options we're going to be talking about today is going to be your FHA Streamline, which is for your existing FHA borrowers, and then your VA IRRLs or IRRRLs for your veterans that are refinancing their VA loan. Each program is designed for different government-backed loans, and of course, each one has their own unique guidelines. Each have their own kind of little nuances when it comes to that. But at the end of the day, the same goal is reducing borrower payments while simplifying the refinance process in general. So the first one we'll talk about is the FHA Streamline. Now, reason why we're talking about that first is FHA Streamline is typically when most people think of the word streamline, this is the program they're thinking of. This is the one that if somebody brings up that name to you, FHA is what they're mentioning when they say just the word streamline. And that's because it is the most popular out of these options. It's designed for those borrowers who currently have an FHA loan on the home that they originally purchased. And the goal is simple. Allow a borrower to refinance quickly with minimum documentation while at the same time improving their financial situation. So, biggest thing here, I'm going to skip kind of down to the bottom of this slide. And I bring up this word because it's going to come up a lot in today's presentation, and that is net tangible benefit. Net tangible benefit is your main kind of crux, your main point, your center point, I would say, when it comes to all of these streamline options. And that is what these agencies want to see in order to ensure a borrower is qualified to actually get a streamline, both in the case of FHA and VA. So, biggest advantages: reduced documentation. In most cases, FHA streamlines, you do not need an appraisal at all. Faster processing, the potential to lower their interest rate, and of course, minimal underwriting because we don't need all of that documentation we would traditionally need on FHA. We don't need an appraisal to be reviewed. So that makes things so much easier and kind of straightforward for that. But the biggest piece there, as I mentioned, is demonstrating that net tangible benefit to ensure that they can qualify for a streamline. And we'll talk about those specifics as we go through. Now, I mentioned in some cases there for the appraisal, and that kind of transitions us into the two different versions of an FHA streamline. So you have here your non-credit qualifying. So that's typically the one that most people want, is the non-credit qualifying, because there's no income documentation. There's no asset documentation. There's absolutely no AUS required. And when it comes to the credit report, we just need a mortgage only credit report. So you don't need a full pull credit report on a non-credit qualifying FHA streamline. Now, there is a credit qualifying version of the streamline as well. That one does need income documentation. It does need a full credit report. We do need to have full assets verified, all of that. Now, the reason why a loan will switch to a credit qualifying is if you are removing a borrower, if you're adding or removing. Anytime the borrowers change on a loan, that automatically flips it to credit qualifying, where we would need a full kind of underwrite. We need all the traditional documents you would need on an FHA standpoint if you're removing or adding a borrower to that loan. So, for example, borrower A, borrower B, they purchased a home together. They got an FHA loan. There we go. They are now qualified. They're able to go forward and move forward with a FHA streamline. But borrower B wants to be completely removed from the loan. For one reason or the other, they don't want to be a part of that loan anymore. So then what happens then is that because they're doing a streamline and because borrower B is now being removed, that triggers that now we need a full credit qualifying streamline with income documentation, assets, and a full credit report for borrower A. So that's the biggest piece there. If nothing changes, everything stays the status quo from one loan to the other, you can move forward with a non-credit qualifying, simplify the process, speed it up significantly because we don't need all that documentation when it comes to that. So that's the biggest piece there to keep in mind of why an underwriter might say, actually, we got to switch this to credit qualifying. That's one of those things to keep in mind when you're having your conversations with your borrowers. Now, from an occupancy standpoint, it is for owner-occupied properties only, and it must be their primary residence. The borrower must document that it is their primary residence by providing an employment documentation, utility bills, or even through third-party verification. So as long as one of those things is provided to verify they live in that home as their primary residence, that will be perfectly fine and acceptable for an FHA streamline. If for any reason there is failure to document that, the property automatically gets classified as an investment property if we're unable to document that as their primary residence, which then, of course, would disqualify them from getting an FHA loan. For a payment history standpoint, this is how they're actually eligible to use an FHA streamline. The biggest thing to keep in mind is that they have to have made 6 on-time payments since the closing of the purchase loan. And if it's been longer than that, so let's say they've had that particular home for 5 years. So of course it's been longer than 6 months. at least the last six payments prior to loan application have to be made on time in order for them to qualify for an FHA Streamline. But the biggest piece there, most of the time you have people like that, but you also have people who, let's say, they're purchasing a loan right now. The example I give is they're purchasing a loan right now that has a down payment assistance associated to it. So now they want to do an FHA streamline in order to lower the rate because that DPA rate was much higher than traditional FHA. So now they want to do that streamline to get them in a better financial situation from a rate standpoint. And they have to look, okay, have they made at least a minimum of six payments on the current loan? And has it been 210 days since that loan originally closed? As long as they have no late payments in the last month, they've made those minimum of six payments, it's been 210 days since the original loan closed. That demonstrates that the borrower has repayability, the ability to make repayments. They're a strong and steady borrower. They are eligible to do an FHA streamline. So that's the biggest thing is FHA stating that they have a strong payment history by showing the 6 months and how long it's been since the original loan closed. So here comes that net tangible benefit that I mentioned earlier. This is the most important piece, other than what I just showed you about the timeline of when you're actually eligible to use an FHA streamline. The biggest piece here that FHA stands from an FHA guideline standpoint is the borrower has to receive a benefit in order to be considered for an FHA streamline. And that benefit can be either a lower interest rate, it could be a lower monthly payment, or it can even be that the term of that loan has shortened. So if they get a shorter loan term, even if the payment doesn't change, if the loan term has shortened, that still qualifies as a net tangible benefit, specifically under FHA's guidelines. Now, if the loan term does change, there is one specific thing to call out here, is that if the term reduction is less than 3 years, there is a specific of where the new rate needs to be. So the new rate does need to be 0.50% less than the existing rate if the term is only reduced about 3 years or less. So keep that in mind if you're trying to do those two things hand in hand. But like I said, most people use an FHA Streamline just to get a lower rate, or at least at minimum, get a lower monthly payment for that borrower. And either one of those would qualify them for an FHA Streamline under that net tangible benefit. From a mortgage insurance and maximum loan amount standpoint, you'll see there that there is an annual MIP of 0.55% on a Streamline, and there's an upfront MIP of 1.75% of the base loan amount. The maximum loan amount is whatever the lesser is, so whatever the lower number. So it's either the outstanding principal balance or the original loan balance. So whichever one is the lower number is going to be where your maximum loan amount can be on a Streamline. Plus your allowable items. So that's any interest that's due, late charges, or escrow shortages. When you go ahead and do your closing costs, if the borrower is getting any type of money back on the closing costs, the maximum amount that they can get back is $500. So just keep that in mind. And then just to wrap things up from an FHA Streamline standpoint, like I mentioned, if you are doing a non-credit qualifying FHA Streamline, these are the only documents that you need. So you can see how quick and fast an underwriting can happen on an FHA Streamline if you're doing a non-credit qualifying. So all you need is the existing note, a government issued ID, a social security card, the mortgage only credit report, and a payoff statement. Those are the only items required on non-credit qualifying. So as long as you provide all those items up front when you register that new loan with us in our system, submit it as an FHA Streamline, there you go. Underwriting has everything they need. They have all 5 items. Double check. They'll go through, make sure if there's anything additional that needs to be conditioned for on top of that. And if so, they will. But if not, speeds right there through the system, giving that awesome opportunity for a lower rate, lower payment, or a shorter term when it comes to your borrower on an FHA loan. So that's why FHA is one of the most popular options when it comes to refinancing the Streamline specifically. And when you have markets where the rates go in a great place, then you'll be able to use this in an awesome opportunity for those borrowers. All right. So a question just came in. Does FHA Streamline allow financing closing costs, lumping them into a new loan? So we would follow FHA guidelines when it comes to that. So how HUD's guidelines state on when it comes to that. So I personally don't have the answer specifically at this moment. We can get back to you on that. But I know that we don't have specific um, overlays or anything to that. We would just follow traditional HUD guidelines when it comes to financing closing costs. All right. And then the last program we're going to talk about today is the VA Streamline or the VA EARL. So this is specifically for a VA to VA refinance for your veterans. And very similar to a FHA Streamline, same thing. No income documentation, no assets, no ratios. And big one for VA specifically, no termite inspection required. So traditionally VA requires that termite inspection, but for their version of the Streamline, they don't. And there's also a maximum term increase. So that's something to keep in mind specific to VA. VA has a max term increase of 10 years plus 32 days. So when you're having a conversation with your borrower, see exactly where they are on their loan, like how far in they are. And if that term is going to change, we need to check to see where that maximum is going to be when it comes to those calculations. Some things specific to call out for VA. When it comes to employment, you leave that completely blank on your 1003. So when you're completing an application on a VA Streamline, make sure you leave the employment section completely blank. Income is not required. There is absolutely no LTV cap. There are no AVMs required. We do allow for tri-merge soft pulls that as long as they show three scores. And we can also do a no score on VA. So that's something that's different, big difference from FHA is VA, we can actually do borrowers with no score on a VA Streamline as long as they are a qualifying veteran when it comes to that, which just as it says here, makes this one of the most flexible and simplest refinance options out of all the different products we offer here at MLB. Now, once again, that net tangible benefit comes into play. The borrower has to show a clear financial benefit in order to proceed. For VA, what they call out specifically is that the interest rate must be lower, which in the same time it decreases the payment, or the borrower is able to move to a shorter term. So either one of those options would qualify for that net tangible benefit specific for VA. Big piece as well here is that the recoupment of their closing costs must be within 36 months or less under VA's guidelines as well. So that's the biggest piece here that fits within that net tangible benefit. They're going to be able to recoup their closing costs within 36 months or less, and they're either going to get a lower payment that lowers their lower rate that lowers their payment, or they get a shorter term than what they're currently in on their house. So either one of those would qualify them hand in hand with that closing cost recoupment as the net tangible benefit for VA. Now, this is just something that applies across the board when assets are needed or not needed. So, big thing here, assets may not be needed when funds to close are less than the new mortgage payment amount. If the funds exceed this amount, so if they do in that case, then there's going to be additional conditions to source the funds and make sure they are verified. So that's something to call out that applies to both FHA and VA. So overall, the whole reason for us meeting today and going over these two streamline options is to show you the real opportunities you have by using FHA Streamline VA EARLs. They lower borrower monthly costs, payments and costs. They close loans faster, help more families refinance, and at the same time expand your pipeline. Because like I mentioned, you can build relationships with borrowers, families that you assisted in the past, and reach out to them and say, oh, hey, you got an FHA loan originally, or you got a VA loan originally. It's been 6 months since we closed that original loan. I was looking at the rates. They're in this place. we may have an awesome opportunity to get you into a lower rate, a lower payment through an FHA Streamline or through a VA IRRRL. Or even if it's been longer than 6 months, you can look back on your pipeline and then now not only you adding another loan to your pipeline, but at the same time you're building relationships with those clients, those families that you've worked with in the past. And then, of course, you show your expertise and your confidence in it, and they start spreading the word saying, hey, I really enjoyed working with that loan officer. Maybe you should reach out to them about uh, purchasing a new home or refinancing your home. So it opens up more opportunities for you in the kind of full overall everything for that. And that's exactly going once again back again to our mission here at MLB, making lives better. And that's exactly what these programs do. If you'd like some additional resources about the different programs we have here at MLB, the first person to always reach out to is your assigned account executive. They have a wealth of knowledge, of course, on all the programs we offer, how our systems work, everything in between. But we also have our MLBwholesale.com website where you can find our matrices, our programs, our videos, and presentations on not just these programs, but all of our other Making Lives Better programs. These presentation slides that I use today are currently available on our website, so you can refer back to it, click on the links that are available in here. Use this as a great reference tool to give you that refresher. If you need a little refresher on a program, we have those different tools there 24/7 on our website. So I want to thank you so much for taking that time out of your day today to join us here on our webinar. If you have any additional questions in relation to what we talked about today, feel free to throw those questions into the chat box, or feel free to unmute yourself if you feel comfortable. I'll be happy to stick around for a few minutes and answer those. Nice and easy, straightforward presentation today on some great products. But we want to thank you again for your time and, of course, for your partnership in helping us every single day to making lives better.